Right now, the S&P 500 is pushing record highs, fueled by an unprecedented artificial intelligence hype. On the surface, everything looks flawless. But under the hood of the global financial system, a perfect storm is brewing. Brent crude oil has surged past $107 a barrel. Simultaneously, the shadow banking system is fractured, with private credit funds facing a staggering $15 billion in sudden redemption requests. Wealthy investors are rushing for the exit doors, only to find they are much narrower than they ever imagined. Legendary macro analyst Bert Dohmen warns that 2026 is the year the entire financial architecture gets put to the ultimate test. And if you own stocks, gold, or crypto, a massive trap has been set. Today, we decode the hidden liquidity crisis, why the smart money is quietly exiting the building, and why gold will crash hard before it shoots to the moon. Welcome back to WealthShift. To understand where your money is safe, you must understand the concept of distribution. Wall Street is highly skilled at hiding market tops. Distribution is the quiet process where major institutional players and smart money insiders liquidate their massive positions, selling them directly to the retail public. While they sell, their media talking heads go on television claiming everything is wonderful. The public is left holding the bag right before assets wipe out 50 to 90% of their value. According to historical valuation metrics, the stock market today is drastically more overvalued than it was in 1929, right before the Great Depression. Take a look at popular stocks being aggressively recommended across financial media. Some have recently reached a price to earnings, or PE ratio, of 388. Think about what that actually means. If you owned the entire company and collected all of its earnings, it would take you 388 years just to get your initial investment back. Wall Street manipulates earnings estimates downward so companies can easily beat them on paper, creating a false sense of security. In reality, we are sitting on the highest overvaluation in human history. But the real epicenter of the upcoming shockwave isn't the public stock market. It's the hidden shadow banking market, specifically the private credit sector. A critical report from Moody's revealed that the fund finance market has quietly grown past $1 trillion. Here is the plain English translation of what is happening. Private equity and private credit funds are holding highly illiquid, toxic loans. As economic pressure mounts, their wealthy investors are demanding their cash back. But because the underlying loans cannot be sold, the funds are actively borrowing massive amounts of money at the corporate level just to pay off the investors who want out. This is dangerous leverage layered directly on top of extreme illiquidity. This isn't speculation. It is happening to the largest institutions on earth. Take the Harvard Endowment Fund, worth billions of dollars. Because their capital was locked up in completely unsaleable private credit assets, they recently could not generate enough cash to cover basic operating expenses. Instead of liquidating their investments, Harvard literally had to go out and borrow billions of dollars in debt just to pay their bills. Just like in 2008, when Wall Street repackaged bad subprime mortgages into complex CDOs, banks today are packaging these private fund loans into asset-backed securities to dump the risk off their balance sheets. It is a massive game of musical chairs, and the music is about to stop. This brings us to the ultimate safe haven asset, precious metals. In times of severe systemic distress, gold and silver act as critical protection. However, retail investors are about to face a psychological test that most will fail. When a true liquidity squeeze hits the global markets, margin calls skyrocket and hedge funds freeze up. In that exact moment, big institutional investors cannot sell their illiquid stocks or private credit. To raise immediate cash and survive, they are forced to sell the only liquid assets they have left that actually have a buyer, gold and silver. Because of this, precious metals will experience a sharp, short-term decline as the broader market runs for the exits. This temporary crash will terrify regular investors, causing them to panic sell their gold at the worst possible time. But history shows that precious metals always bottom out much earlier than the general stock market. As soon as the liquidation phase ends and central banks intervene, gold and silver are set to fly sky high. As legendary trader Jesse Livermore once noted, big money is made by sitting, not by trading. If you buy precious metals, your horizon must be long-term. When the system begins to fracture under the weight of this debt, the Federal Reserve and global central banks will have a stark choice. Let the entire banking sector go bankrupt or print an Astrons.